Imagine putting away just $500 a month, reinvesting every dividend, and decades later that pot is quietly paying you over £50,000 a year without selling a single share. That's the dream behind the Dividend Snowball, and today we're testing it on a real, well-known high-yielder, M&G, currently paying around 5.8%. This is an illustration of the maths, not a recommendation to buy anything. A dividend is simply a slice of company profit paid out to shareholders, usually every few months. With a DRIP, a dividend reinvestment plan, instead of taking that cash, you automatically buy more shares with it. So next time the dividend is even bigger. Do that for long enough and the growth starts to feed on itself. That's the snowball. It sounds simple, but the assumptions holding it together matter enormously. Here's the theory in numbers. Put in £500 a month for 40 years. Assume an average 5.8% return is reinvested throughout, and that pot could in theory grow to around £941,000. You'd have only paid in about £240,000 of that yourself. The rest is compounding, doing the heavy lifting decade after decade. That's an assumed return, not a guaranteed one, and capital is at risk the whole way. Before we celebrate the snowball, let's be honest about where the growth actually came from. Over the last 5 years, M&G's share price alone has climbed by roughly 72%, a fraction of what's needed to explain that near £1 million outcome. Almost all of the total return has come from the dividend itself, reinvested quarter after quarter. That's crucial because it means the whole story depends on the dividend continuing to flow. A yield sitting near 5.8% doesn't appear from nowhere. It usually means the market has already marked the shares down, pricing in doubt about the future. Sometimes that skepticism proves overdone and the dividend holds fine. But often it's an early warning that profits are under pressure and a cut could follow. This pattern even has a nickname among investors. A dividend trap is what happens when investors chase a big headline yield, only to watch the company cut its payout not long after. The yield was never really that generous, it just looked that way because the market already expected trouble ahead. This is exactly why a single company's dividend, however attractive today, should never be treated as a fixed, guaranteed income for life. This isn't theoretical. Household names across banking, energy, and insurance have slashed or suspended dividends during downturns, often right when investors relied on that income most. A dividend can be reduced or scrapped entirely at a company's discretion, with no legal obligation to maintain it. Building a 40-year plan around one company's continued generosity assumes a consistency that history simply hasn't always delivered. One way analysts sense trouble ahead is dividend cover, comparing a company's earnings to the dividend it actually pays out. If a business is paying out more than it comfortably earns, that dividend is running on thin ice, and a cut becomes far more likely sooner or later. This detail rarely makes headlines, yet it matters enormously to anyone leaning on one stock's income for decades. That £941,000 figure rests on one heroic assumption: a 5.8% yield, fully reinvested, holding steady for 40 straight years without interruption. In reality, yields drift, get cut, get restored, or the whole company gets taken over or restructured. This is an illustration of a mechanic, not a forecast, and the real outcome could end up considerably higher or lower. If a cut happens early in the snowball, before much capital has built up, reinvestment simply buys fewer shares going forward, and the whole trajectory shifts lower for years afterwards. If it happens once the pot is already large, the pound figure damage is bigger, hitting income right when it's meant to be paid out. Either way, timing risk is real and entirely outside anyone's control. It's easy to focus purely on income and forget the share price itself can fall, sometimes for years, shrinking the value of the whole pot alongside any dividend received. A lower share price does mean each reinvested pound buys more shares, cushioning some of the blow, but it doesn't erase the loss in underlying capital. Capital is genuinely at risk here, not just the size of future income. Every risk we've covered, cuts, traps, thin cover, bad timing, falling prices, comes from the same root cause, relying on one company for decades of income. Whatever happens to M&G specifically, good or bad, happens to the entire plan alongside it. That single company concentration is the real reason this needs a much closer look before anyone treats it as a ready-made blueprint. So if one high-yielding share is risky, what's the sensible version of this dream? Many investors spread the same idea across dozens or hundreds of dividend-paying companies, often through a low-cost index fund or an income-focused fund. One firm cutting its payout barely dents the total because the income is coming from a whole basket rather than a single name. Where this sits also matters. Held inside a stocks and shares ISA, dividends and gains typically grow free of further UK tax, which matters enormously over 4 decades of compounding. Allowances and rules change, so the current limits are always worth checking directly on gov.uk rather than assumed from an old video. Strip away the single ticker, and the real lesson of this illustration isn't buy M&G. It's that reinvesting an income stream consistently over a very long time is what turns modest monthly amounts into a large hypothetical pot. The 5.8%, the 40 years, and the exact stock are all just one way of making that maths visible. The hardest part was never the arithmetic. It's staying invested through the falls. Dividend investors who panic sell during a bad year lock in losses and switch off the very reinvestment engine that was doing the compounding. Patience, not stock-picking skill, is often the biggest single ingredient in these long-run outcomes. Bring it all together, and the shape of the dream still holds. £500 a month, reinvested for 40 years at an assumed 5.8%, could in theory grow into a pot worth roughly this much. That single number is why dividend investing captures people's imagination in the first place. From that pot, a yield around 5.8% would pay somewhere near £54,500 a year without selling a single share. But every part of that sentence rests on assumptions. A yield that holds, a company that survives, and 40 years of steady reinvestment that no real investor experiences in a straight line. The honest summary: dividends reinvested over decades can be a genuinely powerful engine, but a high yield on one company is closer to a story than a plan. Spreading that same discipline across many companies inside a sensible tax wrapper keeps the snowball rolling without betting the whole outcome on one firm's next boardroom decision. That's the dividend snowball, warts and all, the dream, the maths, and the very real risks sitting underneath it. If videos like this help make investing ideas clearer, do subscribe to Clear Money UK for more deep dives just like this one. Thanks for watching, and we'll see you in the next one.